Hi, this is CH. This video is part of a series of videos titled My ABCs, or Absolutely Biased Comments, on one investment fund per video to share how an individual investor like you and I can try to find out more about a fund from public sources and do some basic research or simple due diligence on the fund before deciding to buy or walk away. Some quick disclaimers before we start. This is not a product sales pitch or a recommendation to buy. I'm not sponsored by anyone to do this video. Please do your own research and be clear about the product features and risks before taking any action. The information shown and mentioned in this video is accurate as of the date stated here. In this video, I will be talking about the Xtrackers MSCI World Utilities UCITS ETF that goes by the Bloomberg ticker XDWU. The utilities sector is essential in all urban planning across countries. Being part of what we categorize as infrastructure, utilities sector typically focuses on the essential services of production, provision, and management of electricity, gas, and water, as well as sewage and waste management. Beneath every road in every modern city lies a complex maze of piping and cable systems that serve the necessary utilities purposes. When it comes to investing, the utilities sector tends to be rather boring, as these companies are supposed to provide stable and consistent utilities services instead of looking for high growth opportunities or make adventurous business changes. In this case, boring is good, as the utilities sector is one of the few defensive sectors that can potentially do well in a weak or recessionary market environment when growth stocks tumble. Many of us actually learned this when we were young through the Monopoly board game. There is always the two utilities tiles that don't really look exciting compared to buying land and building houses, but are actually decent early investments for long-term play. Everyone needs utilities, regardless if you are an individual or company, if you are rich or poor, or if you have any political or religious biases. As such, the utilities sector is typically considered as the one evergreen defensive equity sector that will just chug along across market cycles. During heightened market uncertainties, utilities sector is usually being featured as one of the top choices for investors who would like to stay invested in the equity markets, just like what is happening now. Through the Xtrackers MSCI World Utilities UCITS ETF, I will be discussing in this video whether you should invest in the utilities sector and what purpose would it serve in your portfolio. As a passive ETF, the Xtrackers MSCI World Utilities UCITS ETF tracks and replicates the MSCI World Utilities Total Return Net Index. We will spend a quick few minutes to run through this index. MSCI is a US-based financial company that specializes in providing market indexing business and investment portfolio analysis tools. While the indexing business covers fixed income and real estate asset classes as well, MSCI is best known for its equity indices, in particular the popular MSCI World Index series. The MSCI World Utilities Index is a portfolio of stocks that consists of large and mid-cap segments across 23 developed markets countries that are classified in the utilities sector as per the Global Industry Classification Standard, or GICS. This means you won't see utilities companies from emerging countries, which in any case is not an established universe yet to find enough investment opportunities. Electric utilities dominate the sub-industry breakdown as electricity is the primary energy usage in our world today. Gas utilities, in contrast, is a small component. Water utilities is very small as well, as water is a controlled resource and therefore significantly lesser companies focusing in this area. Country breakdown-wise, US takes about 2/3 exposure and the rest are mainly Europe regions. The index constituent weight goes by free float adjusted market capitalization approach, and the index is rebalanced on quarterly basis. There are around 70 to 75 constituents, and the top 10 constituents comprise over 40% of the index. Again, these are dominated by the electric utilities companies. Let's now go through the ETF. Xtrackers is the branding of the exchange-traded funds and exchange-traded certificates business from DWS Group, a German-based global asset management company. DWS was originally Deutsche Bank's asset management business and was spun off via IPO in 2018. Deutsche Bank, however, still holds majority shares in DWS. DWS manages over 1 trillion euro of assets with majority from Germany and EMEA. The Xtrackers products are part of the passive investment solution offerings that comprise 1/3 of the overall assets. DWS is one of the leading ETF providers in Europe, and therefore it is quite common to see their products when global investors search for UCITS ETFs. The Xtrackers MSCI World Utilities UCITS ETF is a sub-fund under the Xtrackers IE plc fund family that is set up as an Irish umbrella-type open-ended investment company with variable capital. Xtrackers provide very detailed information of their products in their website and fund documents. The ETF that we are looking at is specifically the 1C share class that was launched in 2016 with over $400 million of AUM currently. Given utilities sector is generally a less exciting and popular exposure, the AUM doesn't look too substantial, but this ETF is actually the largest Europe-listed ETF covering global utilities sector. The ETF is base currency in US dollars and is accumulation only, and has a low total expense ratio of 0.25% per annum. Besides US dollars, the ETF is also available for trading in Euro, Sterling, and Swiss franc unhedged. While Xtrackers is popular for its swaps-based ETFs, this ETF uses a direct full physical replication methodology, which means it will hold the same physical stocks with allocations as close as possible to the index it tracks. The ETF portfolio is generally similar to the index, with the exception that there is about 1% set aside in cash and money market funds to facilitate daily trading liquidity needs. What is really useful is that the website provides the full holdings details updated on daily basis that can be downloaded easily if you would like to do separate analysis on the data. Looking at performance, I would first like to point out that Xtrackers merged a similar Luxembourg domicile ETF into the current ETF, and that corporate action seems to have led to some strange returns data in 2016. So I would ignore that and look at returns from 2017 onwards. Performance-wise, the Xtrackers MSCI World Utilities UCITS ETF looks to have delivered better than what it is intended to do. Normally, an ETF will deliver slightly lower returns compared to the benchmark index because of the fees and expenses involved. However, in this case, this ETF appears to have consistently delivered slightly better returns than the index. I couldn't find an explanation from Xtrackers on this, but higher returns is always a good thing for investors. Now, if we look at longer-term annualized returns, we can get a feel of the expected returns to get from investing in the global utilities sector, which is about 6 to 7% per annum across market cycles. Compared to long-term global equity returns of 7 to 9%, this is slightly lower, but we will discuss what investors got in exchange for the lower returns. Last but not least, if we look at year-to-date numbers of 4.16%, this is probably one of the very few equity products in the market that is still delivering positive returns currently. This is also more than 10% better than the performance of S&P 500 and MSCI World indices. To assess the relative performance of the utilities sector, we revisit the MSCI World Utilities Index, which gives us a comparison versus MSCI World and MSCI All Country World indices. As illustrated from this cumulative performance chart, the defensive and boring utilities sector has had a much lower long-term returns, although we can already get a feel of the stability of the sector through the years. For example, during the COVID period, when we saw significant up and down movements of the markets, while utilities sector stayed relatively stable. Now, MSCI World Index has only about 2.69% exposure in the utilities sector. This means the global equity portfolios for most investors typically have very small exposure in the utilities sector. The utilities sector, however, has exhibited decent capital preservation features during some tough times. Looking at the available data from 2011 to 2024, utilities sector delivered better returns in 2 of 4 negative years for global equities, and it is the low correlation effect that interests us most. However, the reverse is true as well. Utilities sector, as probably the most defensive sector, tends to lag behind substantially during strong growth or bullish equity market environments. Given markets run in cycles and do revert to norm over time, there are also some years when utilities sector delivers strong returns above 10%. Another popular approach taken by investors is to shift towards value style during market uncertainties. However, as seen in the performance data here, MSCI World Value at some times perform similar to utilities sector, but at other times perform more similar to MSCI World. So, they do not always correlate. There is nothing wrong with either approach, just that investors do need to note the outcome may be quite different. So, what does this all mean? In essence, investing in the utilities sector is a situationally useful play. Additionally, the approach is rather different for short-term market timers versus long-term investors. For investors that make active short-term adjustments to their portfolios and relies on market timing, there is obviously a need to have an active view on the market directions. If the view is that the market is moving towards a substantial drawdown phase, overweighting utilities sector gives a decent likelihood to reduce equity losses as exhibited in the past track record of the sector. This, however, also means that the investor tends to stay invested in the equity markets, just that the portfolio exposures are being adjusted defensively. On the other hand, if the investor is more focused on long-term play and tends to ignore short-term market noises, then the question would be on the returns versus risk expectations. As before mentioned, the utilities sector delivers around 6% per annum in the long run, while global equities give about 7 to 9% per annum. However, utilities sector do offer a low correlation effect, and therefore can help to reduce performance volatility over market cycles. So, by adding more utilities in the portfolio, the investor can reduce extreme return scenarios. For some long-term investors, having a more stable return certainty is more important than having higher but more volatile returns. With that, let's summarize our findings. The Xtrackers MSCI World Utilities UCITS ETF is managed by DWS, a leading ETF provider in Europe that offers UCITS ETFs to global investors. The ETF is the largest in its category in Europe, with over $400 million AUM. It also has exhibited a good long-term performance track record, delivering positive tracking error versus the index every year since 2017. The global utilities sector, as represented by the MSCI World Utilities Index, has exhibited low correlation to global equities, so it is a viable risk diversifier in equity portfolios. More importantly, it has shown to be more resilient during significant market drawdowns. In particular, looking at the positive 4% year-to-date returns of the ETF and index, contrasting with most other equity exposures in negative returns currently, this makes utilities sector an interesting consideration in the current market environment. We, however, discussed that investing in utilities sector is useful but depends on the situation. Investors should understand the pros and cons before overweighting utilities in their equity portfolios. This concludes my absolutely biased comments on the Xtrackers MSCI World Utilities UCITS ETF. If you find this video useful and would like to see more related contents, please subscribe to the channel. Thank you and have a great day.